Recently, there's been a lot of criticism of crypto projects launching a token with high, fully diluted value, but low circulating supply. This has led many to ask, are VCs and influencers dumping on retail? Critics argue that this strategy benefits early investors, such as VCs involved in pre-seed and seeding funding rounds, at the expense of later participants who buy into the project at inflated valuations. The concern is that this approach not only harms individual investors, but also damages the credibility of the entire crypto industry by promoting unsustainable practices and fostering distrust. There is a call for change in the way tokens are launched and distributed to ensure fairness, accessibility for all potential investors, emphasizing the importance of creating genuinely valuable tokens that offer equal opportunities. In today's episode, we will discuss what exactly is low float and high FDV. Are VCs and influencers really dumping on retail? Or is retail just rage quitting these coins and buying meme coins instead? What happens when there is too little supply for there to be meaningful price discovery? And most importantly, what does this mean for you as an investor and your bags? GM, good morning and welcome to Milk Road Radio, the easiest path to get smarter about crypto. I'm Jay Hamilton, joined by Kyle Reidhead, and we believe that on-chain is the next online. Kai, welcome back to the show.
Thank you, sir. Excited to be here once again.
Let's start at the beginning here. For those who don't know, what is low float, high FDV mean?
Yeah, crypto is a funny world because you have the technology jargon that is hard for people to wrap their heads around and understand. And then you also have the finance jargon that's hard for people to understand. So it's a very complicated industry. So for those listeners that don't know what the heck this means, don't worry, you're not alone. There are many that have no idea what the heck this means. It's a weird word. But basically, I'll explain it like this. High FDV tokens, this just means high fully diluted valuations. What does that mean? Well, you have a certain amount of tokens. Let's say a company or a protocol has, 1 billion tokens, okay? All of those tokens times the price of that token is what the fully diluted valuation is. Now, the weird part about, well, it's not even just crypto, this happens in traditional finance as well, is that sometimes not all of those tokens are available for people to actually buy and sell, right? They are tucked away and they'll be released at a later date, whether that's for investors or for incentivizing or whatever. And so what the float considers is the circulating supply. How many tokens are actually available for people to buy and sell? This is your market cap. This is like the circulating supply. So that certain percent of tokens times the price. So you have a market cap, you have a fully diluted valuation. A high FDV means it's very, very high in price. I mean, WorldCoin, for example, was worth like 150 billion. And yet it only had like 2% or less than that of its supply available. That's low float. There's not much of its token actually available. That's what we call low float. And so what's happening is there's a lot of tokens that have released in the last, year, let's say, whether they're airdropped or they've launched, whatever, and they release with like 2 to 10% or 15% of their circulating supply available. That's called low float. And so what it means is it makes the fully diluted valuation of this company look much higher than it actually is. So that's what low float, high FDV is.
And why are we talking about this right now? Not just why are we talking about this? Why is everyone talking about this on Twitter?
Because crypto Twitter likes to make up narratives and find something to talk about. To be honest, the real reason this is happening is because over the last 2 months, previous to the ETH ETF getting approved, a lot of people just lost money, right? Bitcoin pulled back about 20%. All the altcoins got completely wrecked, especially many of these low float, high FDV ones. And so a bunch of people were losing money and they were pissed off. And so everyone went to Twitter to try to figure out what's going on. And they decided to blame VCs and make up a bunch of other excuses, which we'll talk about today. Some true, some probably not so true. So probably that's why. What's funny is I think once the ETH ETF got approved and ETH went up 20%, I was like, well, no one's talking about this conversation anymore. It's like, well, everyone's bags are happy. They've made money. And so what we're talking about this because we're trying to get to the bottom of why are there so many tokens? Because over the last 6 to 9 months, we've had so many airdrops. So there's been a lot of new tokens that have been put into the ecosystem. Many of them are this idea of low float, high FDV. And so we're just trying to figure out, is this a good thing? Is this a bad thing? Is this screwing over investors? What's kind of going on here? And that conversation is just kind of really, ignited across crypto Twitter over the last few weeks.
And as you said, really trying to get to the bottom of, is this a not just for investors, but for projects. Because what we're going to talk about at some point in this show is this might not be so uncommon when you compare to TradFi, but we'll get there later. First, let's talk about the outcome of this that a lot of people are saying is that VCs and influencers, because influencers often get involved in early fundraising, just like VCs, are dumping on retail. That is the main narrative that has come out of this low float, high FDV conversation. In your view, is that true? Is that actually happening?
So I don't think so. And the reason is if you're investing in solid projects like we'll call it tier one projects, they tend to have tier one VCs. So your good VCs that you think of A160, et cetera, et cetera. Okay. And these guys have specific rules and specific contracts where when a token goes live, they're not able to sell. They get vested for a year or 3 years or 5 years, depending on what it is. These guys all have long-term time horizons. And it's part of their contracts that they actually don't get their capital as the TGE happens. So when the token goes live publicly, whether it's high float, low float, whatever, it doesn't really matter. They don't even get access to these tokens. So they actually can't dump on retail. It's actually not possible. Now, this isn't true of every token. If you buy some shitty tokens on some shitty launchpad that's on Binance, Smart Chain, or whatever, that has, these like no name VCs, probably they are dumping on you because they don't have any restrictions. They actually force contracts where they don't get these vested contracts. But like most of what we're talking about here are these bigger projects like WorldCoin and like Jupiter and like legit projects, EtherFi, et cetera, et cetera. These are tier one VCs that are investing these tokens. And these are the type of tokens that have typically been part of the conversation, though I'm sure there's many people that are buying the like low end ones. That's probably happening there. I don't think it's really happening on the VC side for the better tokens because it's just mainly it's not possible. Although I would say like in the TradFi world, this is how it works, right? Like you get private investment for your company because you can't IPO and like have your stock available on the NASDAQ when you're a $1 million company, not even a startup. You need to get capital somewhere and you got to get it through someone, and VCs are going to be the ones that do it. And so like companies should be very grateful that VCs are giving them money at a angel or seed round when they don't really have a business. They have no revenue. Retail normally wouldn't invest in that. And then eventually IPOs and now retail buys. And then of course, those that invested early can then sell. That's the whole point in giving millions of dollars to a company when it's worth nothing, is so that you can sell when it becomes liquid. Is that happening here in the crypto world? Potentially, but I think to a lesser extent than in the TradFi world, to be honest.
Interesting. Okay, so summary, VCs and influencers might be dumping on, well, they are dumping on retail in certain cases of low quality projects. But when it comes to tier one projects, it's not happening. This is a narrative that is untrue. Let's go to the second thesis here is, okay, is retail just rage quitting all of these tokens and buying meme coins instead?
Yeah. So this is the idea that, well, in April is really why this conversation came up, because everyone's tokens got crushed in April. It was about mid-April. And so everyone's like, well, maybe just no one's buying these tokens anymore. And they are instead buying a bunch of meme coins. Mm-hmm. I would say the data doesn't suggest that. If you look on like Binance, for example, if you look at volumes, meme coins only make up about 14%. So it's not that much. Also, meme coins had their moment in March, and they really have sort of fizzled out. I don't want to say completely, but they've sort of fizzled out, and they'll still have their moment, by the way. But it didn't correlate with the time that all these tokens got dumped. These tokens got dumped because markets dumped. Everything went down. ETH went down. Bitcoin went down. Everything went down. And so, of course, these tokens are going to go down too. Is it because retail's given up on these? I don't think so at all. Maybe it's because these things had high FDVs, and so they're overvalued. And so people didn't want to buy them. Maybe it's not retail. Maybe just people are getting smart. Because like, when we wrap up, I think my big takeaway from all this is like, look, it doesn't really matter what the situation is. If you're buying WorldCoin at 150 billion FDV and it went down 50%, that's on you. We don't need equal rules and like make sure that you don't get in when tokens are valued high. This is a game. These are markets. They are free flowing. And if you're going to buy something that is valued at 150 billion when it's a tiny little app, that's completely your fault. And you can't blame VCs or that the market has left for something else. Again, that's on you. Go be first in meme coins if you think everyone's leaving meme coins. So the data doesn't suggest it has anything to do with meme coins. It actually just might be investors are getting smarter.
No way, not possible. Okay, so second theory, the investors are not, retail is not moving from, or at least the evidence does not show that retail is moving from these tokens into meme coins. Final theory that I wanted to discuss is there too little supply for there to be price discovery? If the fully diluted value is so high and the supply that is currently circulating, the low float is in this low range, 10%, there's obviously a large range. Is it too little for there to be true price discovery? And that's why there's so much volatility in these tokens?
This definitely has something to do with it. It's something people need to be aware of. I think the average for all the tokens over the last however many months is around like 12%. I think it's 12 or 12.3 or 12.5, whatever it is, in terms of their float, how much of the circulating supply is available. And that is quite a small amount, especially if these tokens also have staking or some other primitive to it, right? This is what's kind of different about crypto versus like TradFi with shares. Like if you hold shares, you can't do anything with them. Crypto, you can. And so if you have a small circulating supply and you actually can like go and stake them, like Mode, for example, okay, that could be problematic. And so I do agree here. There is some issues in terms of price discovery. However, if you look at all the tokens that dropped last cycle, same thing. It was around 12% as well. So there was really no difference. Even if you look at equities when they IPO, their median amount of shares that are available when they IPO, 12%. So it's actually pretty much on par with what we're seeing now. So like, this is why I say like, I don't really think this is a crypto problem specifically. Sure, maybe there's ways to improve it. Like I do think teams should try to get more tokens in their circulating supply when they launch. It is better for price discovery. It is somewhat more fair, but ultimately like, I don't know, these guys need to hold back tokens because again, there's utility in these tokens. They can use them for incentives. They can use them for airdrops. They can use them to do marketing. You can't do that with shares in a normal TradFi company. So I think we also need to like think a bit differently about what's happening here in crypto versus what is happening over in like the TradFi world.
Interesting. So regardless of how this is happening or why this is happening, I think what we're saying is that it is happening, but the question is it a problem? And I think that's where I want to go to next. And if it is a problem, what do we do about it? And so there's been a lot of theories spread around. I'm just going to read a couple of potential solutions that have been presented. People have said we should bring back ICOs. We should unlock 100% immediately, more like meme coins do. We should list tokens at lower prices to allow retail to buy earlier and win some of the upside. Or we should go back to fair launches. Kyle, what do you think? Do you agree with any of these solutions? Do you think that do you even think this is a problem?
I don't think this is a problem. I don't think it deserves as much of a conversation as it's had, to be completely honest. If VCs were dumping on retail in like a very problematic way, then sure. I don't think that's the case. Influencers actually probably do in some cases. Influencers don't need as much. So the KOL rounds, they don't need as much vesting. Sometimes they unlock right off the bat, but their share is quite small. So I don't think it really matters that much. But in terms of those solutions, like I do think there is things we can do to be better. There's always ways that we can reiterate and like try to make this better. Bringing back ICOs, this is actually part of why I think this happens is the SEC doesn't allow for ICOs. And so because of the, I guess, like fear around securities laws, et cetera, these tokens, these protocols, they need to launch these tokens, right? They need to get them out to public, but they can't allow the public to invest early on. So because of the SEC, at least in the US, they are forcing these companies to not raise from the public, but instead they have to raise from VCs. I'm sure many of these protocols would love to raise from their community, but they can't because then they'd be called a security and then they would get fined and then they would go to business. And so what's happening here is actually, I think this is a symptom of the SEC holding this back. And so ICOs technically is a solution to this. However, they're illegal. You can't have ICOs in the US. And so a lot of these companies that come from the US, they just can't do this. And honestly, even companies outside the US don't want to do this because they don't, US customers might buy them, et cetera. So I don't know that ICOs is a good solution. And to be honest, I don't even think that works, even if it was legal, because if you look at 2017, when we had ICOs, it actually meant that the public could get dumped on. People were just putting any money into anything. There was no rules. And like, I don't know that anyone should be able to buy any token at, before it even has any project at all. A lot of people got screwed on the ICO days. And part of that is because go back to the unlock 100% immediately. In ICOs, they weren't always unlocked immediately, but the team got a bunch of money right off the bat and they didn't have to be vested. And so teams would just leave, right? They made their millions. Why do they need to go and build what they were going to do? They would make a white paper. They would launch an ICO. A bunch of retail would go, I'll put in all this money. Whereas VCs won't do that. They'll talk to the person and make sure, like, are you legit? Are you here for the long term? Are you going to build something? Retail will just, take my ETH. Like, you see it on Twitter all the time. People like literally put out a wallet address on Twitter, like, send me Sol and I'll give you this meme coin, and people do it. And like, I don't think that that's a good way to do this, because that just means teams make a bunch of money and then they peace out. So I don't think that's smart. So bringing back ICOs, unlocking 100% immediately, I don't think it's a great idea. Also, in terms of unlocking all your tokens immediately, I think that's a terrible idea for a project, because these tokens, as I said, they have utility. They can be used in points programs or in airdrops, et cetera, to incentivize people to actually use their products or to use their products in a certain way. I think that's an amazing marketing tool. It is a way to get people to come use your protocol and then reward them for using it. I think that's amazing, because the alternative to that in the Web2 world is I'll pay Facebook or Google or whatever big tech platform to run ads to get in front of these users to have them use my platform. Users make no money from it. Facebook makes all the money. Instead, with Web2, with Web3, with these tokens, I'm now just going direct to the users and paying them. I think that's actually amazing. And so if a team was to unlock 100% of their tokens immediately, they lose that. You don't get that anymore. And so it's like blowing your load too soon. You don't want to do that. So I think that's a bad idea for projects. Listing tokens your third one, listing tokens at a lower price to allow retail to buy early and win some upside. That's the worst idea I've ever heard in my entire life. And so I'm not even going to comment on that. Like, these are free markets. Why are we giving an upside to retail? Even if you did do that, institutions or smart individuals will figure out a way to bot that and win that anyway. So retail's not going to win that regardless. So I don't know. I don't think there's a ton of good solutions out there. I just think we need to keep playing around with, like, what is the right supply. And honestly, the supply is going to be different depending on your protocol and your business. Like, WorldCoin had to launch at 1-2% supply because their whole business revolves around rewarding people that come and sign up. The idea of WorldCoin is to give everyone a WorldCoin in the future, but there's only, 2 million people that are using it right now, which means there's still 99.9% of the world that need a token at some point for signing up. If they just released all their tokens right now, their business model makes no sense. And so, like, we can't bucket them all into one thing. We need to think a little bit more differently about this and understand that these tokens have use cases and utilities. And so we can't just give them all out at any point. And also, we can't just favor retail because they're getting perceived getting dumped on. We don't need to make things better for retail. Retail just needs to get smarter. They are called retail because they are the dumb money. And I say that in quotations. I'm not saying that all retail is dumb, but like, this is a game. That's what investing is. You don't just like prop up the ones that are the worst at the game. That's not how this works. No game should ever work that way. So I just think, I don't know. I don't know what the best solution is yet. I think we just need to keep iterating and see what works. But I don't think there's a huge problem.
No participant trophies in Kyle's world.
No free ribbons. No way. It doesn't make any sense.
Okay. Before we wrap here then, Kai, what's your takeaway, and what would you advise investors to be doing in order to make sure that they're not falling into a trap here?
Yeah, I mean, investors need to look at FDV. Everyone's so caught up on market cap, and the only thing that you should be looking at is FDV, to be completely honest. Because, well, I mean, you should know both. You want to know the ratio, because FDV is the real valuation. It is what people are actually valuing this company at. Like, WorldCoin at 150 billion, but it was a pretty small market cap. It was so obvious you should never invest in that at that point. It made no sense. There was going to be more unlocks. It's so overvalued. So don't look at market cap, look at FTV. The second thing is, like, if a token airdrops and there's a TG, just because it's a good protocol or it's the next shiny thing and everyone's talking about it, it doesn't mean you need to buy it. Look at the valuation. Is it valued at like $20 billion? Like, Wormhole came out at like close to 20 billion and that thing's down like 60%. Is that a problem? No, it just would have been ridiculous for you to buy that token at $20 billion. The thing just launched, and it launched at like, I think maybe 10% circulating supply. So what does that mean? One, it's probably overvalued. And two, over the coming years, there's a bunch of tokens that are going to get unvested, which means, yes, a bunch of people that gave liquidity to this company early on so it could survive and build and pay its team, They're going to get tokens that unlock. And what do you think they're going to do? They've been investing in this company for years. Of course, they're going to sell their tokens. That's not a bad thing. But as an investor, you need to be aware of that, right? You need to look at this FDV. You need to look at how many tokens are coming out, and you need to look at token unlocks. Because if there's 10% of the supply coming on the market next week, that's probably a bad thing. You probably don't want to buy that token. But mainly, like, you don't have to buy every new shiny thing, right? You can hold your ETH, you can hold your Solana. And when the opportunity is there, like Wormhole is now down 60%, maybe now's a good time to buy, right? If you just looked at the FDV and you understood unlocks, like, okay, maybe you just need to time it better. I think that's what investors need to be aware of. You don't just FOMO into whatever's the shiny next thing.
Kai, fantastic wisdom. Thanks so much for joining the show and breaking down this complex issue for us in such simple terms and helping our listeners be confident in their investments. Appreciate, again, you joining us today.
Absolutely. Thanks, everyone, for listening. Hopefully this was helpful. Can't wait to be on next time.
In case you missed it, here's what happened last week. The GameStop saga continued, and Roaring Kitty might become a billionaire. Now, last week, Roaring Kitty posted on Reddit for the first time since 2021. He disclosed that he holds over 200 million in GME, which led to a price surge of GME stock of over 100%. And also liquidating short positions of $1 billion in a day. Now, on Friday, Roaring Kitty went live on YouTube after a 3-year absence, fully proving that he is back. And now, if GME hits $70, which is still a long way off from, but with Roaring Kitty in the mix, you never know what's possible. Roaring Kitty would become a billionaire. Also, in case you missed it, last week, Robinhood acquired Bitstamp for $200 million. Now, obviously, this is a strategic move that positions Robinhood for significant growth in the European market. Bitstamp boasts a 13-year track record and a solid reputation in Europe, a market where Robinhood seeks expansion. Now, Bitstamp has 4 million users, and they sold at 200 million, so that essentially equates to a $50 per user fee, which is an incredibly attractive price for Robinhood considering the lifetime value of a customer. This deal allows Robinhood to leapfrog competitors like Kraken and eToro in Europe, gaining immediate access to Bitstamp's established user base. Thanks so much for listening in, everybody. Hope you have a great Monday and an awesome start to the week.
Thank you for listening to Milk Road Radio, the easiest path to get smarter about crypto. If you like this episode, share it and hit subscribe or follow so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, then we'll leave a link to Milk Road Pro as well, your #1 resource to help you invest successfully in crypto. One final note, this podcast is for educational purposes only, and nothing we say is financial advice. Crypto is risky, so you should never invest more than you're willing to lose. Thank you, friends, and we'll see you in the next one.